So in this video, I'm going to talk about the 8 common mistakes new investors make. Over the years, we've made a tremendous amount of mistakes. We've seen others make the same mistakes too. So we're here to highlight and talk about some of those mistakes that we've made or others have made, right? And help you as a real estate investor avoid making those same mistakes. Welcome back to Money Mondays. We're releasing a new video every Monday. These videos are based and rooted in our experiences. So we're here to share to you about what you can do to help grow your real estate. We've purchased over $700 million in real estate over the years, thousands of investors, and we're constantly looking to continue to build up our investor pool and help provide better than market. First mistake we see people do is unexpected expenses. Whenever you buy real estate, you should always have replacement reserves, right? Which is money that you're going to spend to kind of cure things that get worse over time, like an air conditioning place. But then you also need to have additional reserves. This is money that's just set aside on the sideline for kind of a rainy day fund. Things like insurance is really a good example. This year, insurance has gotten extremely expensive. People are being killed left and right because they didn't plan for insurance getting so expensive. Taxes is another common one. Understand that on paper, a deal is very straightforward, but in reality, the deal is much more complex. And so you need to prepare for unexpected expenses. And if you plan accordingly, then you can survive kind of the impacts of each of those. And so over the years, we've constantly increased what our reserves amounts are. We've made mistakes in the past where we were probably under reserved, where constant problems happen and we just didn't have enough extra reserves and cushion to be safe. Now, we probably do about 3x the amount of reserves that we did historically. And so we may buy a deal today for, let's say, $15 million. That deal may have $2 million in reserves just sitting parked in the side, in an interest-bearing account, just helping us have that in case we need it. Now, remember, the more reserves you have, the lower the returns become on the deal. So you have to plan for it accordingly. It's a little bit of a balancing act. But again, we like to say that it's a safer investment is better than no investment. Next up is vacancies. Vacancies do happen. Real estate is a cyclical market, right? Renters are cyclical as well. You need to plan for vacancies and kind of work through that, right? A lot of times we buy properties and we do what's called value add, and we're going to go in whenever the unit becomes available, update the interiors, and then rent it out. Well, guess what? It takes 30, 45 days to get an interior upgraded sometimes. That means that unit is offline for longer. In addition to that, you may have a lot of other construction projects going on around the property. Well, a property with a lot of construction on it is not that attractive, so you're going to have less tenants as well. And so again, typically in year one, we underwrite a much, much lower occupancy than what we think we can have. And so again, as you're doing your business plan for lower than expected vacancies, especially the first few years. And in addition to that, start to basically say, okay, what do I think market vacancies are? We see some people that think that they're going to have 96% occupancy and that's always going to be true. That's not true. That's really hard to maintain because as you have fewer units available, right, the delta to turn and get them leased gets harder as well because the timing starts to impact it. So again, understand both your economic occupancy and your physical occupancy. Physical is what it sounds like. How many people are in the unit, what units are available. Economic also factors in the other things that are being ignored. Is that unit a model unit? That unit being provided for free to an employee or security? And then last but not least, what kind of bad debt or vacancies do we have and how many evictions are happening, right? Are things having to written off? Because again, you may have a unit with someone sitting in the unit, but if they're not paying rent, well, really that's not occupied from it. Next up is financing. We see some people that think they're always going to get 80% leverage and 5 years IO. Not accurate, especially on your first deal. It's going to be harder to get financing. You need to plan for that. In addition to that, remember, real estate is cyclical. The market changes. Even for us, and we've done 20, 30 deals, right? Depending on where the cycle is, it can be harder to get financing than it was previously. We're doing a development project right now where we realized that getting new construction financing has completely dried up. We've had to kind of go back to the drawing board and plan differently. So again, as an investor, understand that financing can impact your deal, and that can be a problem even after you get the deal under contract. So make sure you have a couple of different ways to finance the deal, a couple of different ways to structure the deal for it to make sense in case one of those falls apart. Next up is property management. This is where we like to say that the real work happens. A lot of people think they can just buy a deal, hand it to property management, check out. Guess what? It's not that simple, especially in the current economic environment. Operating deals is tough. It's the hardest part of the business, and everybody really fixates on buying the deal versus operating the deal. But again, that's where your deal can live and die. So for us, we ended up starting our own management company. We've learned the hard way that relying on third-party management can be hit or miss. Now, there's some good ones out there, but there's also some not great ones. And that can basically put a deal in a situation where it's going to take years to unwind and fix. And so again, really stay on top of what happens to your deal after you buy the deal and kind of, get ready to asset manage that deal. Get ready to ask the tough questions and track things. And most importantly, make sure you find a property management company that you love and understand and work well, or get ready to start your own property management company, which is very hard. I don't recommend it because again, there's a lot of industry knowledge. Again, getting a deal. So when choosing a property management company, right, you want to first and foremost find one that's going to be honest with you. A lot of management companies will promise a lot more than reality, and those are the ones that we've seen that will quickly just look to get the business and then ride it out as long as you can until you fire them. And changing property management companies is really hard, and they know that. And so again, look for a company that's going to be honest with you. They're the company that's going to tell you, you know what, I don't think you can get $1,300 rent. The market says $1,100. We'll try, but I want you to grade us based on $1,100. That's one example. Understand what other deals they have in the area. Are they able to support that deal or not, right? Is it their only deal in that market? They're just hopeful that they can get someone out there, or do they have 15 deals in the area and they can actually drive? And so again, the property management company is essentially your partner on this deal, and you want one that's going to be honest with you and tell you what you can actually expect, and then kind of they give you the bar to grade them on and work from there. You don't want the property management company that's going to promise the world, because from our experience, that doesn't usually. Next up is market fluctuations, right? It's easy to ride that high where you're getting the big rent growth. We had this happen recently in Austin. We were getting 30% rent growth on our deals. Weren't doing a lot, but we're getting 30% trade outs, which is unheard of. Guess what? We kind of hit a brick wall immediately back in kind of February. The market changed and the rent growth completely slowed down and stopped. So realize the market is a cyclical thing, right? Real estate is not always high, it's not always low. It goes in kind of troughs and tranches. So plan for that and know that the business that works today may be different than how it's going to be tomorrow. And that's where it goes back to having reserves, planning for changes, and working through them, right? And getting to ride the highs and avoid the lows. So if you're seeing rent growth stop or slow down, or maybe you close at the wrong time, don't freak out, plan for it. And that's where going through eyes wide open and understand what's happening in your market. This is very different between markets. And the other thing I want to add too is there's a very seasonal component to the market. Not only do markets go through highs and lows, there's an aspect where, guess what? Summertime is your peak leasing season, especially in apartments, right? That is the time you want to go into it eyes wide open, having units ready to go online, available to rent, and you lease those units as fast as you can. You can maybe start to get those premiums. Versus if you're going to go do a big CapEx and, let's say you're going to take 30 units offline to upgrade, and then you're going to bring them back online in November, it's going to be tough to lease those. So again, be smart about it. Understand there are cyclical aspects to it and plan for them, and that way you can help avoid. Next up is legal issues. If you're in the business long enough, you're gonna have legal issues. So that's where it's important to have the right insurance, right? Your GL, your umbrella, your hazard, these things happen. We've had so many slip and falls, right? Where someone will say they slipped and they're gonna try to sue the property, or maybe that they fell into a hole, right? That was really just a kind of a small recessed piece in the dirt. All these things happen. And so as an investor, first time it happens, it can be a little bit unnerving, right? But realize it's about having the right structure, having the right attorneys, and just know that that's part of the business. And so again, some tenants are great. Some tenants are trying to take advantage of a situation. And as an investor, it does suck, right? It is always stressful, but know it's part of the business and it's okay, and you can kind of solve it and move. And that's why we like to say, have a good vendor pool, right? Your attorney is part of your team and they can help navigate you. They've seen what can happen. They've seen what works and what doesn't work. They'll help steer you. So make sure you have one of them on hand on your roller. Next up is overestimating returns. It's easy to fall in love with a deal. A lot of people do, right? And you start to ignore the challenges that can happen. You start to say, you know what, maybe we can get a better occupancy. You know what, maybe I can get a better income, better rent pop. You know what, maybe I can reduce expenses a little bit more. And if you start to slip a little bit here, slip a little bit there, slip a little bit here, these things start to compound. They can make a bad deal look good. And so again, sometimes you have to step back and say, okay, how likely is it? How many of these likelies am I trying to be really aggressive in? So many people overestimate returns, especially the first couple of years, right? That they go in expect the world and don't deliver. Their investors are upset. So that's where it's really important to taper expectations in the first few years. You included. We like to say that we don't really know a deal that we buy until we've had it for 14, 15 months. It takes more than a year to really get situated, understand the deal, understand its strengths, understand its weaknesses, so you can actually work the business plan. Right? The business plan we start with is almost never the same business plan we end with. We're constantly making refinements based on the data, based on what we're learning on the deal. So don't go in overestimating returns. Investors will continue to invest with you if you set the right expectation with them. So we really like to taper that expectation in the beginning and then work towards performing, and really we hope to overperform the expectation. But if they go in with the right expectation, you can meet that and they'll continue to invest. And so that's why we like to say it's important to understand the numbers. Real estate, it's a very numbers-driven business. So again, you may not be the most mathematically inclined, but it is important to go and understand them. Most of the math, it's not hard math, but it is a lot of math, right? It's mostly about addition, multiplication, subtraction, division. You're not doing calculus to model these things, but each of these things build up and add to the other. So it's always important to understand and go build out and know what your model looks like. I have actually recommended, so there's models out there you can buy. To get started, I actually built my own from scratch. Why? It's so I can learn more intimately how all of the numbers relate to each other. It's easy to understand them conceptually. Hey, I'm gonna have 10 units, I'm gonna rent them for $1,000, so therefore that's $10,000 of income. But then start to layer in what happens in my expenses. Layer in, what about my debt? And as my debt changes, what does that do to all my expenses? Or layer in how much cash I brought to close the deal and what my returns are on that. These things, again, they all tie together, and it need to go and spend the time to go learn how to underwrite. Last but not least is personal finance. Someone on the deal needs to have additional liquidity and net worth as a backup. You have those reserves we talked about earlier, those are a safety net. But if push comes to shove, right, as a good investor, you need to be ready to step up and put additional cash in the deal. It's how, again, what we said earlier is you can stay in the deal long enough, right, with real estate, it usually fixes it, given all the things we talked about. And so some people go in with no reserves or low reserves, and they don't have any additional liquidity. One problem happens, they're giving that deal back to the bank. That's an issue. So again, make sure that you or an uncle or a friend or another partner have additional liquidity that you guys have already figured out in case something goes wrong that was unexpected, just to be able to help you make it. So with that said, right, real estate can generate true wealth over time, but it's important to make sure you don't step on a landmine in the process. And so in this video, we kind of highlighted some of the mistakes that we've seen or we've done ourselves, and you need to go out there and understand each of them so you can avoid them. You can avoid these mistakes, a lot of the rest of the project and the business plan gets a lot easier. So if you're a new investor, I know a lot of this can be overwhelming, right? But it's all manageable. And if you're not comfortable with these things, right, find a good operator that will invest and do all this work for you. Obviously built the experience over the years, and that's why investors invest with us, because we can help avoid making these mistakes on our investment. If you have additional questions about this video, leave a comment. We'll be happy to answer them, right? If you have ideas for future videos, go ahead and leave a comment as well. We'll go ahead and have the team work on some of those. If you also like this video, go ahead and share it, like it, tell your friends about it. We'd love to kind of learn and teach other people. With that said, hopefully you've learned some of the mistakes that we've made and you can help avoid them yourself. See you next time.